Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, and joined here once again with Dan Mickelon. How you doing, Dan?
Very good. How you doing, Ben?
I'm doing good. Still working on my voice coming back. I've had some struggles with that, but hopefully our audience can bear with that today, and we can get through what I think is going to be an amazing show. Who's targeting your 401k is the question today. We're going to go through target date funds, and we are going to open those things up, and not all of it smells good, honestly, when you really break it down. But before we get going, you can reach us at 855-226-8551 if you have questions. We'd love to hear from you. You can also email us at info@yourmoneyontap.com. That's info@yourmoneyontap.com. Target date funds are something that have become a common household name in people's retirement plans over the last 10, 15 years. It's just part of the simplicity of how people think of investing today in retirement. And there's a lot of things inside the target date fund that I think our listeners, which we've tackled in the past a little bit, but I think we're going to dive into it in a way that's going to bring more awareness. And I think people are, with this market movement, this downturn that we've seen this beginning of this year, I think it's really going to be made aware what's kind of going on in this space for investors.
Yeah, like a lot of things that seem simple on the surface, what you uncover as you understand it more and more, that there's some inefficiencies built in there, and it's not.
That's a nice word, Dan. Yeah,
the shortcut doesn't always work. Sometimes you're better off, doing the real work to get the better outcome. It's just the way of life,
Yep. Sometimes you try to take a shortcut, and it ends up being a longer road. And that's what we're going to get into today, and I hope you stay with us for this show, because it's really going to be valuable for you, your friends, and the people you know, because this is something everyone should have real strong awareness on. But before we get into the crux of that portion of the show, we have for you our Money in the News.
And first up, we get an article here. This is from Market Watch. It's written by Mark Hulbert. Inflation may be a lot lower than anyone thinks, even the Fed. And what this really is about is how the CPI gets measured. Traditionally speaking, when you hear these inflation statistics and people refer to the CPI, what they're doing is they're looking at it over a 12-month span. So, for instance, they look at April 2021 to April 2022 and see where it all stands. And because of the way inflation's behaved in the last year, some of that number may be a little bit skewed, because what we've had happen is inflation didn't really spike until kind of late in the year. So earlier on we've had earlier on in that calculation we've had low inflation numbers, followed by some significant spikes. And the number is what the number is, but changes that are happening in more short-term intervals, like month to month, don't really average out the same way. It's kind of getting diluted in the statistic. So I think it's important to note that there have been, and this article references some fairly significant changes in the short term, but they don't really move the needle on the annual number.
And I think that's the thing. I mean, we've had this inflationary spike, and we're all feeling it. I mean, there's no question across the board, everyone's feeling it. And the Fed is trying to mitigate, kind of a long-term approach. And I think the article makes a really good point that what is in the past is in the past. Like these, horrible months of, inflation, though, if you just look at the last 12 months, it's not 8%. It's 8%, for the last month. But the average annualized rate is closer to 4%. So, the idea that this whole year could end up at 4 or lower with the Fed raising rates is what the Fed's goal is. I mean, they said they want to get inflation down to that 2% range. I think that's really important to understand because, yeah, we have seen this dramatic increase in inflation in this short term, and we hope it's a short term. We hope this is not a continuous thing. I think we all have those fears. I think we all think that there's a real likelihood that that could continue. We don't want to sound naive in that, but I think the article is making a good point that the Fed is doing everything they can to get these numbers down. Now, we've done shows on the real inflationary rate, and we could calculate things 15 different ways to Sunday and find out that actually it's twice this or half that, and it's every perspective and what you're including or what you're not including. And years ago, I mean, you listen to the Fed and you'd hear them say, well, we're not including oil and gas this year. This is years ago. I remember it was like 10 years ago because it, hasn't, the increase has not lasted more than 12 months. Well, 12 months later, they still weren't including it because this was during the Obama years. It was, well, they're like, well, it's just not a component for everyone's need. And, so they make up things, what to include and not include and what reasons are around that. So there's a lot of debate around inflation, but I do think that, unfortunately, shoving the interest rates higher could have the adverse effect and not the effect that they really want, too. And that's a fear that a lot of people have.
That could be the outcome, but I think what the article is suggesting here, too, and this is relevant in that, the number is that we refer to here in the news all the time. It's a backward-looking number, right?
Yeah.
You can't change what's already happened. So the math is going to work out to be the math, and whatever policies the Fed enacts or changes that are coming down the pike as a result of those things, it's going to be slow to take effect. So the news is unlikely to change, at any time soon because even a sharp downturn today wouldn't really factor into the numbers until probably a year from now. So the best indicator is probably the simplest indicator. What's gas cost you? What are your groceries costing you? What are you actually paying to live life?
And I think that's one thing that, the Fed doesn't really do a good job speaking about is that inflation is different for everyone. Like there's inflation for you, Dan, and for me, and we live different distances from the office. So your gas inflationary event is lower than mine because you're only a few miles away, right? So that impact is different for everybody, and it's really hard to quantify what you, the listener, and what your inflation is and what our inflation is and how that might completely be different. If you're not the consumer of large amounts of travel, then, gas is going to have a lower impact on you, but it's not going to have no impact. So.
Yeah, no, the gas continues to shock me. I'm lucky enough to live very close, but my wife has your commute, right? She goes Bedford to Concord and back every day, so it's, it certainly gets felt. And, that's the one thing that's, I think, most disappointing in the government reaction to all this for me so far is, we're supposed to release all these reserves and 1 million barrels a day for the next 6 months and, et cetera, et cetera. We don't import from Russia. It shouldn't affect us. Well, it's affecting us. What's going on?
And it just hit the highest month ever in the gas price.
So, explain it to me. Like, what's happening here?
Well, they're still shutting down more pipelines, Dan.
Well, that's not good for a year from now, but unless that pipeline went directly into my car, it doesn't matter. It doesn't matter for today.
All right, next up, CNN. Markets are down, but these charts explain why investors shouldn't panic. There's a lot of different moving parts here that make things different than lots of the different, crashes we've seen in the markets over the 2008, 9/11, the years in the crisis with Enron and all the different things that have happened in our market cycles. There's a lot of things here specifically in this market that are causing kind of an equalizing event of bulls and bears, people buying, people selling, and not this huge, just gigantic sell-off of just, being every time we bounce down a little bit, we get a massive rally. Why is that? Why is that happening? I think there's a lot of evidence that for our everyday listener can understand is as you're going down the road, everyone has a for higher sign. The idea that recession is right around the corner, could it happen? Yeah. But there's an entire group of people that say it's absolutely not happening. I was listening to today on CNBC. There's no chance of a recession. And then there's 5 other people on there saying there's absolutely a recession coming. They don't know.
I think, we watch this all day long. So you're looking at all these, CFOs and analysts and people who literally focus on just this. And from what and this is, just listening and kind of a mental tally, but, more or less all of them seem to peg the chances of our inflation in the next 24 months at about 35%, 35%. It seems to be like the number, right? So that's, really only a 1 in 3 chance that this is happening, right? But it feels as though the markets have priced
You said
in.
inflation, but you meant recession.
Recession. Did I say inflation?
Yeah.
Recession. Yeah, inflation on the brain, right? So, a 1 in 3 chance shouldn't have this kind of negative impact on the market. So what that tells me is that a lot of what's happening here and these couple of down weeks we've experienced is really just emotional, just fear.
Yeah, I think one of the notes in the article says the 14 bull markets since 1932 have returned 175% on average, while the 14 bear markets starting in 1929 have resulted in an average loss of 39%. That means that you need to be in the market. You need to absorb loss. You need to be part of that. There's ways to mitigate some of that loss, and we have, mechanics in our portfolios that do some of that, some of the 200-day moving average and some of these specialty things that we do. But in reality, you need to be in. And even with our, even the 200-day moving average we have in some of our managed portfolios, some of that money went to cash in mid to end of April, I believe, on the S&P. But, that was 10 to 15%, which has helped us against all the benchmarks. But the market's moving down in that space. Meanwhile, there's, the large blue chip portfolio is doing really well this year. We're actually up, so that's so the different disparities between those portfolios are interesting, but you need to have diversification and you need to be part of the market to actually have the returns. But I think that when you really start looking at the variables that are different in this market versus other markets and other time cycles, there's a lot of things that are bringing speculation that people think are solutions around the corner, like the war in Ukraine, right? Everyone kind of has this feeling that it's going to end. There's going to be some negotiation. There's going to be something that happens. People have that kind of feeling, and Russia's Russia, and they're always going to be jerks, and so we're just going to try to calm them down again. And it's like the child that you don't want to have to deal with. But they have their temper tantrum. They take what they're going to take. We give them what they're going to get, but no one really thinks it's turning into we're taking half of, Europe again.
No, it's, the geopolitical impact of that conflict, is really not something that we can remove from the markets and how they perform over time. There's always something happening in some place.
Right.
Now, this one has a little bit more impact because of Ukraine's, role in the global resources market, right? The wheat, the grain, all those things. So that shipping got shut down. That has a little different impact than some of the other conflicts that are out there and that have occurred. But conflict will always be there. Geopolitical crisis will always be there. Squabbling with OPEC over oil flows will always be there. And the market still, throughout the history of this, has continued over time to return positively. And that's the thing you have to keep in mind with this is, the people who suffer the worst in these situations are the people who sell at the bottom out of fear. Right? If you run away from it completely, you're likely to take a significant loss and feel so badly about the loss you took, you don't get back in when the time's right. And you just compound your issues. Yeah,
absolutely. And the idea that there's pretty much a pullback, a downturn of some sort every 4.5 years is really kind of a normalcy. And so trying to just mitigate a little bit of that and be cautious is really the primary role that I would tell the average investor to focus on. But the bigger the dip, the better the return long term. I thought that was an interesting point in the article. The idea that, it's the worst pullbacks that had the greatest gain opportunities.
Yeah, well, think about it. Markets, whenever the recovery does happen, it reaches the previous high and then exceeds them, right? So that would make sense. The deeper the hole you're coming out of, the steeper the climb up, right? But one other thing that I thought was interesting about kind of the way the markets behaved in the last couple of years is that it said 15%, this is a 2021 survey, 15% of all the stock market investors say they first began investing in 2020. So we have just got a massive inflow of new retail investors who have only experienced, bull markets, really, where they got in when the market was steaming hot and have continued to be there.
They're mostly buying GameStops. So.
Yeah,
I mean,
that's a lot of day trading on the phone. That's what that is. But there's a lot of cash on the table, though, and that probably gives a significant description as to why some of those kind of hot tech stocks, performed the way they did over the last few years, prior to the downturn. It wasn't based on any metrics or any performance of the company. It was just massive inflows of money, and these were the hot names.
Yeah, and I also think the idea that people are not quantifying the government's printed so much money, the idea that these stocks aren't going to inflate naturally due to the amount of money and inflation around them, just due to that, don't lose sight of that. That's a big piece of what our market's going to see over the next 3 to 5 years is these stocks inflating just because of inflation.
Yeah.
So, all right. You want to take this last one, Dan?
Yeah, this is from Money Talks with Jim Cramer.
I just can't say the guy's name.
I know. This is actually on CNBC, but this is his usual spot here. But Jim Cramer's advice for how to invest during a recession, and this is a quote from him, "There's always a bull market somewhere," which is very, very Cramer-ish right there for sure.
I think this is one of the things. He talks a little bit about some of the high yield dividend producers, the blue chip space, the Procter & Gamble's, the Coca-Colas. I looked at Salesforce today, was up pretty significantly. It's been moving. There's a lot of different opportunity there. I think this is one of the reasons, why our blue chip portfolio has done so well this year. We're actually up. So that's a big statement in this kind of downturn market. The piece of that is that people are running to a flight of quality and they're looking for income or yield. And the bond portfolio is really struggling. People are losing money in bonds and, no one wants to buy a Treasury paying 1.6%. That's just not what people are looking for in their portfolio. It doesn't meet the needs. And when you have, Coke and Procter and Johnson & Johnson, these companies yielding anywhere from, 2 to 4% potentially, that's not a bad return for income for somebody who says, I don't care if the stock goes up and down as long as they pay me my income.
Yeah, we've talked about it a number of times, but there's nothing wrong with owning a stock that pays you to own it.
Yeah, I like that. Well, with that, that's going to end Money in the News for us today. You're listening to Money on Tap. Today, Who's Targeting Your 401k is our show. We're going to talk about target date funds. We're going to be right back. With that, we have a lot of things that you should know about your 401k and what's behind it and who's targeting you. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Don't go anywhere. We'll be right back.
Folks, it is so much fun for us to bring you Money on Tap. My name's Seth Krussman, and I am one of the hosts here at Money on Tap. I'm also a financial planner. That's what we do. That's what Ben and I do. And the fun part is we get to have this radio show. We talk about important things that we think you need to listen to and be aware of to help raise the bar as far as your financial literacy. It's a big part of what we're trying to do here. The other thing that we're doing here as well, as financial planners, we are welcoming you to come and call us and to join us at Brayshaw Financial Group. Experience what complete wealth management looks like. Let's take a look at all sides of the issue, get a three-dimensional perspective, and put a plan around your next step. It's so critical. And so many people just leave this part out and then they find out later, if I only would have known. Hey, don't let that be your story. Give us a call at 855-226-8551 or info@yourmoneyontap.com. If you have $250,000 of investable assets today, our plan is free to you. We think it's important for you to know the facts and have a playbook so you can have a successful retirement. Give us a call at 855-226-8551. Thanks for listening.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw, joined here with Dan Michelon. We are talking about who's targeting your 401k, the target date fund world. If you have questions on this subject, give us a call, 855-226-8551, or email us at info@yourmoneyontap.com. If you're listening, well, you are listening today if we're talking to you. But today, this is going to shock a lot of people. I think this show and what someone's 401k is and kind of the end result is probably going to leave some people in a little bit of fear. So I say again, here's our number, 855-226-8551. Give us a call. Happy to talk to you about your finances and go through that with you, specifically your 401k. Our first meeting is free consultation. Happy to talk about that. But what is a target date fund? For those of you who don't know, you probably see them in your 401k. You may not even know you own a target date fund, but usually they have a year on it. It's dated for a year that you expect to retire. So you might see a target date fund with a 2035 symbol on it, and you say, well, that's about the time I'm going to retire. If that's in your realm, whether you want to retire at 60 or 65, whatever year you're focusing on in the calendar, they focus on that and they choose that, and they basically invest your money in a lot of funds of funds. And what we call fund of funds is that they're buying lots of different investments that are already set up for you to create this tiered, diversified portfolio that in turn moves to conservative investments over a long period of time.
Yeah, so it has a preset mix, like we've heard either on the show or heard us talking about in general, like a 60-40, 70-30, 80-20. And what that really represents is the percentage of equities and the percentage of bonds mixed into a portfolio.
Yeah, and that percentage of portfolio, that kind of allocation piece, as you're kind of moving through, you're hoping, you're expecting that this manager, Dan, is like getting the investments correct as you get closer and closer to that special day of retirement.
Yeah, these funds were actually built to address what was thought to be underperformance by pension managers, throughout the private and corporate sector or public sector as well.
You mean the idea that they're not making the person enough money?
Yeah, and they're not optimal returns. And another one of these instances where someone believed automation was better than the intellect of some individual. And as well-intended as it may have been, what time has told us is that it's led to a lot of inefficiency and a lot of, frankly, overcharging, some higher fee issues. But those are just some of the problems that we've kind of discovered in this, and we'll get into it. But in the opening, we talked about how, if you're starting a job and you're setting up your 401k allocation, which most people do one time and then never address again, and if that was your mindset or your intention, as folly as that may be, well, picking the date that matches your intended retirement year probably makes sense out of that decision process, right? But the truth of it is that
it seems so simple, though, yeah. Dan. I mean, it is the perfect conversation to a guy who, you walk into your new job, you say, hey, I got to pick out something for my 401k. I'm putting $50 or $100 away a week, and I really want this, but it's not a lot of money. Let me just choose something simple that has diversification, that has kind of my long-term interests in play. And I'll just choose this thing that says I'm going to retire in 2045.
Yeah,
it seems like it makes all the sense in the world,
and that's why they've been as successful as they have been. There's, right now there's $2.5 trillion invested in these.
$2.5 trillion.
They make up about 25% of the 401k pension world, which is astronomical.
And I can't tell you how many people I've sat down with and started educating them on target date funds and some of the things we're going to talk about today. And the next thing that they do is they literally pull out their phone, open it up, and say, let's reallocate.
Yeah.
It is the next step in the conversation. Well, born out of the Pension Reform Act, as Dan had mentioned, in 2006, these things have been around for a while, and they picked up the traction that the world has demanded. I mean, basically, people said people need help in their retirement plan. Like the government said, we need people to have real value, real help. We need people to not invest in a way that's too risky for them in retirement or approaching retirement where they lose their money. But with this recent downturn in the market, Dan, people in these super conservative, ready to retire target date funds have lost over 10% in most of them.
Yeah, in one of their bits of research, we came across the 2020 target date fund. So this is for someone who would have retired or expected to retire 2 years ago. It's down almost 12% year to date. I mean, that's not the kind of hit you want to take 2 years post-retirement or, on the verge of it. That's a significant hit.
Yeah, and there's the other horrible thing about this is that, and we've been talking about this for years. So, anyone wants to go back and go through all of our shows, bonds have been an anchor to a ship dragging behind it. If you're trying to sail forward and you're dragging your anchor, it's going to be a problem from time to time to time, and bonds have been doing that. And now with rates going up, these old bonds that the people have had have just absolutely collapsed on them in their portfolios, which is amounting. You'd think, hey, these really low risk 2020 target date fund, meaning the person's retiring in 2020, 2 years ago, would be super conservative, would have super low risk, and boom, they've lost almost half of what the market's lost.
Well, I mean, the whole time, the notion of a target date fund is built literally on the premise that bonds are safer.
Yes.
Well, who says?
Yeah.
Not lately.
Yeah. They're not safer. They're not better. They don't perform as well. They don't have yield. I mean, they talk about how the Treasury has a historical 5% yield. I was reading that in an article, and it's like, well, not today. And you're not going to create a 5% yield out of something that's producing 1.6.
Yeah, I mean that statistic goes back to the 1920s, but you'd have to go back almost that far to find a bond paying 5%. Yeah. I mean, it just doesn't exist in today's world.
It wasn't even paying 5% back then, but it did eventually pay much higher than 5, and so now we're at 1.6. So you're just not going to be able to create retirement out of that. And on top of it, you're walking into retirement in these target date funds with 10 or 15% less. What do you do? And we're going to have some answers for that as we move on here. Dan, the second item, we breezed over it briefly, but the set it and forget it, kind of the no accountability conversation. Let's talk about that. I think that's the thing that bothers me the most.
I think when most of us, and certainly us, kind of from the professional perspective, when we're looking at any investment on a statement, you look at it, item by item and saying, well, what is this thing returned for me, right? Yeah. Should my money still be there? Should I consider something else? But that doesn't happen with these target date funds. Even amongst the world of target date funds, you might have more than one option, in terms of which mutual fund house is offering it to you. But what the study has demonstrated is that regardless of performance, people stay in and they keep investing in and they don't get out and they don't consider alternatives because it is so simple. It says, well, this is lined up with my target date, so it just has to make sense.
It has to be. It's the answer. You guys have told me the title of it is the answer to what I want, so why would I change it? I mean, it's really horrible from the standpoint of there really is no accountability. There's no like, hey, this is a better one, or this is what they're doing, or these are the sub-account funds that they specifically own, and this is how they're doing. Because they have no accountability, they have no purpose or reason. They've said that they've just basically, all these companies have turned their head and said, here, we chose these sub-accounts. We don't move anything. We don't change anything. We have a specific bond stock mix, and for that age demographic as you get closer, and that is what it is.
They literally have no incentive to perform at all, right? Yeah. So usually, a fund that does well will speak to its performance, and that attracts new money, right? Yeah. So managers get famous for doing well, and people follow managers, and the money comes in, and it comes in, more when you do better. But these target date funds,
that would make sense.
It would, right? Pay for performance, right? But in this instance, you're not, right? So whoever your retirement plan provider is selected which target date fund will be available to you, right. And because it sounds simple and because it's easy, you select it, and then whatever portion of your paycheck every week comes out and goes right into it. And this is all it's all set up. It's all automatic. They have no incentive to do well. They have no incentive to perform or outperform. The money's just going to come by nature of the 401k plans they've associated with. That's it.
It's really sad that that's something that and honestly, when these things first started out, there was really some idea of competition and building the name and making a story around it and seeing people's accounts grow. But honestly, how many 401k people do you? I meet people all the time that say, "Yeah, my 401k goes up," and then we look at it and we're like, "Well, most of this is because you're putting money in every week."
That's right.
Not because you're actually making money. And that's one of the questions and concerns that people have, because when it comes down to it, this lack of accountability shows itself in the numbers, and we're going to get there. We're going to get there on that. The next item is the one size, doesn't fit all. This is a big deal. I think this is probably one of the ideas that is as clear as mud to our listeners, but it's clear as day to us. And the idea that every person, our industry, Dan, and we are compliance officers in our industry. Our industry is literally riddled with compliance of, know your client, know their risk tolerance, their time horizon, their investment objectives, and that no one client is the same. There is no box for everybody. You can't just buy the same investment for everyone and say this is suitable. Yet these target date funds say exactly the opposite. They say that everyone who wants to retire in 2035 has the same investment objective. They have the same risk tolerance.
Before we can engage you as a client and give you anything that even borders on advice, we got to bring you through the 4-page questionnaire. We got to ask you tons of stuff. And, that's how a real professional does their job, is they determine what's good for you. These guys literally ask, how old are you?
Yeah.
Okay, done.
This is
what you get.
This is the bucket you get to go into.
It's literally one question suitability review.
And I was thinking about the the 25 to 30-year-old target date fund that might be like 80% stocks and 20% bonds. And I'm thinking to myself, I've met a lot of 25, 30-year-olds that, and specifically the millennial generation, who are doing very well for themselves, making good money, tech kind of space, and they don't want to own really any big stock bond portfolio. They have no interest. Their risk is totally different. And then yet their 401k, they're forced into it. I've met people who literally put all their money in a money market in their 401k. They don't trust it. So how do you say that somebody who's 30 years old absolutely has to be an 80% equity portfolio? What happens if they want to own real estate?
Yeah,
it's just crazy.
There's really none of the real due consideration that goes into real investment advice taking place, really at all.
Yeah. And if you change your mind and you decide, hey, I'm going to retire early at 55, I'm going to start taking money out of my retirement plan early, and I'm going to work through the tax code to do that, because there are ways. All of a sudden, you're in a target date fund that's not prepared for you. I mean, there's been so many lawsuits over target date funds for either. I mean, there's only lawsuits over how much money people have lost or should think they should have made, but the amount of how aggressive they've been at times where the market's pulled back, that people have gotten burned. But honestly, I'm wondering how you sue a target date fund who owns too much in bonds when you're losing money in something that people in our industry declares as safe.
And that's really kind of the issue to it, is that these funds are basically set in stone by prospectus the day that they get constructed, right? So there is no maneuverability, there's no discretion, there's no ability of the managers to really try and take advantage of a unique condition in the market, right? They just have to follow this glide path from an equity to debt ratio, day by day, year by year, until they get to the end, and it flattens out at retirement age. So it's really, it's truly the set it and forget it model, which, it just isn't the way to optimize a real retirement.
And I think the vulnerability that the people who, the $2.5 trillion worth of owners,
40 million Americans are really struggling with, is that they're not getting the advice to choose anything else. And yet they actually have the advice. All of these 401k plans have the requirement to produce advice on a phone call to help you through, choosing your investments. They have to do that. Part of the regulations. But the investment companies have said, we really love this pension act. Ultimately, this reduces the number of phone calls we get. And it also plays into point number 4, the fee structure.
Oh, gosh, Dan. Before we do that, we're going to take a quick break. You can reach us at 855-226-8551. If you're just joining us, we're talking about who's targeting your 401k and the target date fund world. email us at info@yourmoneyontap.com. We have the answers to your questions. Stick with us. We'll be right back.
If you're listening today and your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
Now back to Money on Tap with Ben and Dan.
Welcome back. You're listening to Money on Tap. I'm Ben Brayshaw here with Dan Michelon. Who's targeting your 401k? Target date funds. That's who's targeting it. We're jumping into this here right now. We're going to talk about fees. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. There's been a lot of conversation about fees in the last 4 to 8 years. I would say that there's more fee awareness in this marketplace than I've ever. People think they're they understand fees. It's sad that the amount of transparency our industry requires has such little transparency when you actually look at the compounding nature of fees and how fees really work in our industry. I mean, people say, well, I could buy the S&P 500 and there's virtually no fees to that investment with Vanguard or Fidelity or whatever. And I explain to people that that's not really true. I mean, that's the fees that they have to report, but they wouldn't be able to open their doors and they wouldn't be able to have people actually cover the phones for that fee and the amount of money that's in there. And yeah, people try to justify it with the idea that, well, it's just so much money is in there. And there's potentially some truth to that, but that's kind of like just adding, millions upon millions of years to the age of the earth just to justify, evolution. It's just not, time and volume doesn't just create clarity. And that's, I think, the thing that's really the problem here. So there's not as much transparency as our industry should have. And if I was in Congress, I would probably rip that apart and make it a new day. But there's even less transparency, I would say, in the target date funds, because for everybody who's really concerned about fees, this is the last place you should go if you're concerned about fees. What do you think, Dan?
Yeah, I mean, the opportunity is just rife there for these companies to, essentially self-deal when it comes to
what do you mean by that, Dan? I think that's...
Yeah, so the statistics out there that we came across in the study here, right? So of the creators of these target date funds, and it's a lot of major mutual fund houses, T. Rowe Price, Fidelity, Vanguard, 58% of them are comprised entirely of their own mutual funds. So if you bought a T. Rowe Price target date fund, it would include all T. Rowe Price. And I don't mean to single them out as the one, but it's just as an example, every one of the underlying funds that make up this bundle that you purchased is a product of their own. So that's 58%. Another 20% have somewhere between a half and 100%.
So that's 78% of all target date funds are using more than 50% of their investments of other homegrown investment programs that they're already designing,
that have their own fee structures built into it, but you don't see that.
Right. And I think that's the thing. Like I was looking at, and I just Googled it, T. Rowe Price's 2035 fund, and the fee was 0.66%, so 2/3 of a percentage point just for the fund and itself. And then on top of it, you have all the other sub-accounts potentially owned in there. And I think that's the thing that people don't understand, because when you start adding all this together, you're way north of 1% for something that a person, you can't sit down. There's no accountability. The performance reporting is for naught most of the time. And
it's not being managed to perform at all. It's being managed to turn the dial on your equity to bond ratio over time alone. That's it.
Irrelevant of your goals, your investment strategies, your woes, your fears, everything.
Yeah, and what else the study had found is that 37% of the most expensive underlying funds are what's included in some of the composition of these. So not only do they get to cherry pick the funds of their own that make up your target date fund, but 37% of the time they're choosing the most expensive options for themselves.
That's atrocious. And if you're in government listening to this, you should fix it. There's just a lot of real problems with this. And the target date funds, I would tell you that our number one belief, irrelevant of our business and so forth, is that target date funds are the biggest waste of money, and 40 million Americans are taking advantage of them. And you're getting robbed. I mean, straight up, you're getting robbed for fees that, you'd pay less to hire us to even do, for somebody who has zero concern or accountability to you or to what your money does, and you're going to continue sticking money into it. You could probably choose the same sub-accounts that they're choosing inside their portfolio, and sitting down with somebody probably every few years and making the adjustments, you could save yourself over 0.5% in costs and expense.
Yeah, before you allocate into the target date fund, just Google it, see what it's holding, and just buy those funds.
Yeah,
save yourself a couple of bucks and get the same kind of meager performance.
And so there's that concept alone that can really drive concern in our care for everyone that has financials. We believe that success is born out of retirement funds that we don't even manage. We want people to do well. We want things to rise for you. I think just jumping into the numbers, Dan. And I was looking for that through the study of, what was it, Dan, with how much the return is. So here we have that in this one article at a Kiplinger, they say, we estimate that over a lifetime, such underperformance results in a 20 to 30% deficit in pension savings at the time of retirement. They're speculating that these target date funds will reduce your retirement next to somebody else not using them by 20 to 30%. You'll have a quarter less money than everyone else in retirement.
It's absolutely unbelievable.
It's the fact that these things are even legal, knowing that all the statistical information out there is just pointing to the red flags.
Is the pursuit of simplicity worth that much to you? It can't possibly be.
I think the thing is this is really where the statement of being a penny wise and a dollar foolish really makes sense, because when you think about somebody, I mean, if you're hoping to have $1 million in retirement, a target date fund might mean that you're only going to get $750,000 or $700,000 or $800,000 next to somebody else potentially buying the exact same underlying sub-accounts. That's astronomically crazy.
Yeah. No, it's really important to, when you're making these allocations, consider it wisely, take advantage of whatever resources exist, whether it's talking to us or talking to another professional, or even calling the 800 number provided from whichever fund family your employer works with, and making them earn it a little bit. Ask them some pointed questions, bring up this topic, have somebody there point you in a direction that would lead you to believe that the advice that you're getting, moves with the times, is aware of market conditions, and understands a little bit about you as an individual, not just simply the year in which you want to retire.
A lot of people don't think they have the power to. They don't have the power to address this. And I've seen 401k plans that only have target date funds as options. So if you're living in that realm, go to your employer, go to your HR, and tell them to listen to our show and tell them that they have a responsibility, potentially a fiduciary responsibility, maybe not, to provide you with solutions that are in your best interest. And if they're not willing to listen, talk to more people at work. I mean, that's really how you change this kind of thing. It's not that you don't appreciate the 401k, but they're being talked into these programs by the different providers because it makes sense. Mentally, it makes sense. It's like, oh, the person's going to retire in 20. Yeah, offer the target date funds. Make the changes. I don't want someone to walk into retirement and lose 12% of their portfolio, but someone just did this year because of their decision. So these are the types of things that people really can and are able to change, and just say, leave the target date funds if you feel that convicted as an employer to do, but give me the other investments that every one of these companies will offer. All it is them going through and doing a checkbox. These sponsor companies only really want the target date funds in there because why? They're reciprocally profitable. They're getting paid for the same investments twice.
The code's already written. They don't need to pay a manager to do it.
Yeah.
It's done.
The fact that they're charging that much money alone just for the target date fund, when in reality that's...
And if the model of it is something that you believe in, or you've heard elsewhere works for somebody, okay, so use some portion of it, but set aside some other allocation of your 401k into something that you're actively managing, something that's more relevant, something that's tuned in with the time, something that you can use this money to take advantage of opportunities. The markets have been down significantly. We at the bottom, I don't know, but I will tell you that there's probably a pretty decent discount built into some of these indexes if you wanted to buy now.
Yeah, there's probably going to be a number more lawsuits just saying that these companies have gotten too conservative with these portfolios, knowing the Fed's been saying we're going to raise rates. Every time the Fed says they're going to raise rates, bond values go down because no one wants to own an old bond paying a lower rate.
I mean, that's the simplest news you might want to react to, that you could possibly make the time-tested, this is what you do when, right? But these target date funds can't. They literally cannot because the prospectus says they can't.
Right. And that's the really driving factor is why are they doing it? Why it's all driven by the core rigidity of what they said they were going to do when you purchased it, and they have to stick to it. I mean, I know people, and I'm not recommending this to anybody, but I do know people that with 401k plans that they only had target date funds offered, and they went with the, I'm going to retire in 2080 option or whatever it was, just to get lower bond exposure inside that. That's an interesting perspective, and something to maybe talk with your advisor about and get some advice on in general.
And generally how all these things are built, and then there's a little bit of variance in there, but beginning at age 50, they start moving you down from a 90-10 ratio.
Yeah.
And it's a steady slope down to, the bond world at retirement date, which is, again, in this environment, not where you want to be.
Yeah. Buy a 2020 bond, retire in 2090. You're listening to Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. As we wrap up this show on target date funds and who's targeting your 401k, I think there's a lot of fear out there. And if you're suffering with that right now, trying to figure out how to retire, and you had a 2020 target date fund and it just failed you, 10, 15, 20%, and you're saying to yourself, I'm not sure I can still retire. Do I need to continue working? Give us a call at 855-226-8551. We can help you. You can also email us at info@yourmoneyontap.com. Thank you for putting up with my voice today. I've been struggling with this for a number of weeks, but we're going to get there. A lot of people are trying to figure out, I lost 15% of my portfolio. I thought I was conservatively invested. These bonds have killed me in this retirement plan. I don't know if I still can retire with the numbers I was thinking about. A lot of people use Monte Carlo. They say, hey, I can take out 3.5%, 4% as an income distribution. I think Monte Carlo is like 3.2. And what Monte Carlo says is, statistically, there's over a 90% chance you won't run out of money. And I think that's 3.2% right now. But a lot of people use 4%. I mean, that's pretty common for people walking into retirement, 4%. So if you had $500,000 in your retirement plan and you were looking at a 4% distribution and trying to provide for you and your wife or you and your husband for life, you're thinking you're going to get about $20,000 a year, or maybe you're getting somewhere between $1,500 and $2,000 a month is what you're hoping for. But now your $500,000 portfolio is down to $400,000, and you're trying to figure out how $16,000 a year, or that kind of like $1,300 a month is going to change. I mean, that's a car payment loss per month, and that's a devastating decision right there. Dan, there's a number of investment programs that we've utilized for clients to help mitigate against that loss. Annuities is one of the ones that are pretty heavily used. All sorts of types of annuities. There's variable annuities, there's index annuities, there's fixed annuities, and so forth. But in the variable and the index annuity space, you can get higher income guaranteed rates for husband and wives. even like 5%. So I mean, in a scenario where $500,000, portfolio where you thought maybe you were going to get 4% at $20,000, if your portfolio is now worth $400,000, get an annuity, provide yourself with a potentially 5% income. Maybe there's even a higher rate depending on your age and so forth. That still gets you to your $20,000, and this market loss is not as devastating.
No, and the benefit there as well is you've secured yourself a minimum rate of lifetime income, which is really the goal of your pension, of your 401k anyway, right, is a lifetime income. But by locking it in based upon that initial investment now with what you have left, there's also the potential that income can increase down the road. So if the market recovery happens like we expect it to, and it happens sometime between now and when you've begun receiving income, or even after that point, depending upon the different product that we discuss and options that exist for you, that income can go up over time. So as the market recovers and rebounds, that may make its way through to your paycheck.
Yeah, and I mean, so basically, you're not losing out on the opportunity to experience the recovery.
You still have that market exposure.
Yeah. But the thing that people don't consider is continued market loss. So as you're trying to figure out how to retire and you're at 400,000, what happens when it hits 300? When do you pull that trigger? When do you make that decision? Because honestly, the market volatility continues to get higher and higher and higher as time goes on. The market's volatile and becomes more volatile because there's so much information. People are moving much quicker. It's not like, hey, buy GE stock, it's 1920, and I'll read about it in the paper next week. If things change, they change rapidly and fast, and that can drastically and dramatically impact your portfolio while in retirement. So as you're drawing out of your retirement and that compounded loss feeling, you take money out, the market goes down, the market doesn't recover what you took out or what it lost. Now you take out more money. It just keeps dwindling away. Taking care of that risk is something that you can, one, do, and two, you can probably make up for the income distribution based on today's loss just by, considering one of these types of programs. There's a lot of questions about annuities. There's a lot of different, moving parts there. But if you're also the retiree or pre-retiree, I should say, that's concerned about further loss, you might have a retirement plan, an old 401k out there that you're looking to say, I don't want to lose another 15 or 20%. I'm within 5 years of retirement. I can't afford to wait 5 years just to get back to where I was 3 months ago. There's ways to mitigate those losses too, and to put some kind of nets under your portfolio. And there's a number of those types of programs where you can buffer how much you're willing to participate in loss and deal with that. And you give up some return opportunities, but still large upsides.
Yeah, and that's this conversation we're having now about you, every one of you listening, you the individual, you with your own goals and aspirations, is what's different between dealing with us and buy or target date fund. Yeah. We're going to consider you, what you want to do, when you want to do it, and what we have to work with, not simply what day do you want to retire on.
And I think the other piece of this is that people want guarantees. People want to just resolve and take care of and know that themselves and their spouse are going to retire, and they're going to retire well, and things are going to be strong, and they're not going to have a fearful day every time the market changes, or checking their phone every time they want to see how their retirement plan looks. What's great about annuities and retirement plans is the fact that, if you're really looking to use your retirement funds for retirement, you're never going to liquidate them in whole. You're going to take income from them because they're a taxable event, and they're something that you want to have last your lifetime. And so annuities actually play a really good, kind of lock and key fit in that space. It's not for all your money. It's not even for probably half of your money. It's for a portion of your dollars to kind of solidify that income need, the base core income piece. And right now, with a market drop like this, they can really help, leverage, step up what you need for retirement. So those are a couple things. The other piece that you can do is take those old 401ks, and if you've got more than 5 or 10 years to retire, give us a call. We can talk to you about, some high yield programs. We can talk to you about some of the stuff we're doing in that space to try to really leverage the market in a way that you haven't, or to use those in combination with each other as you're kind of moving forward. You've been listening to Money on Tap. We really appreciate you joining us today. It's been a great show. I really hope that you're all walking away with some significantly better understanding about how to empower yourself and empower your retirement plan, because that's what it's about, is leveraging yourself in a way that you can actually make more money for what your goals are and who you are, specifically, as you pointed out so well, Dan. Thank you. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Thanks so much, and you make it a great week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.